In today's video, I want to share a simple and highly profitable strategy that uses a combination of 3 popular and free indicators. This strategy is straightforward, but to use it successfully and profitably, you must consider several important factors, which I will explain in this video. Be sure to watch the entire video so you don't miss anything. Additionally, you can apply this strategy to a wide range of asset classes, including Forex, stocks, cryptocurrencies, and indices in any time frame. Without further ado, let's get started with today's video. First, go to TradingView and navigate to the indicator section. Search for the indicator, or use the link provided in the description for these 2 indicators. Customize them to your liking and set the EMA to 50 and 100. For the Stochastic RSI, use the following settings. Now let's discuss the Stochastic RSI in detail. The Stochastic RSI ranges from 0 to 100 and helps identify overbought and oversold conditions in the market. The Stochastic RSI reaches these levels more frequently than the regular RSI, providing more trading opportunities. Let's understand how it helps in our trading. When the Stochastic RSI drops below 20, it indicates an oversold condition. A buy signal is generated when it crosses back above 20. Conversely, when the Stochastic RSI rises above 80, it indicates an overbought condition. A sell signal is generated when it crosses back below 80. Here's an example. If the Stochastic RSI drops below 20, it signals an oversold market. When it crosses back above 20, it's a potential buy signal. On the other hand, if it rises above 80 and then drops below 80, it's a potential sell signal. Remember, we need to use the Stochastic RSI in relation to the trend. As the saying goes, the trend is your friend. Now the question is, how do we find the trend? For that, we use 2 exponential moving averages to identify the trend. Go to the settings and select the 50 EMA and the 100 EMA, and make sure to deselect all other options. After successfully placing all these trading indicators on your chart, let's see how to use them. But before we dive into our simple and mechanical strategy, if you want to support us and help us create more content, make sure to hit the subscribe button and like the video. Drop a comment if you have any questions. It only takes 2 clicks and 3 seconds, but it means a lot to us. As we grow, you grow too. Let's start with the rules for entering buy positions. Here are the conditions for entering a long trade. First, the 50-period moving average must be above the 100-period moving average. Moreover, both moving averages should be sloping upward. Second, the Stochastic RSI should cross above the 20 level, which is a buy signal. Finally, the price action must close above the 50-period moving average. All the rules are met on this candle, so we will open a long order at the open of the next candle. You can set a stop loss on either the 50-period moving average line or the recent swing low, depending on which is closest to the entry candle. Our first target will be the recent swing high. Otherwise, use your risk management strategy for taking profits. Certainly. Here are the detailed conditions for entering a long trade in another example. First, ensure that the 50-period moving average is positioned above the 100-period moving average. This indicates that the market is in an upward trend. Additionally, both moving averages should be sloping upward, confirming the strength and sustainability of the trend. Second, pay attention to the Stochastic RSI. This indicator should cross above the 20 level, which signals a buy opportunity. The Stochastic RSI helps in identifying potential reversal points and ensures that we are buying when the market shows signs of upward momentum. Finally, observe the price action closely. The price must close above the 50-period moving average. This confirms that the upward trend is robust and provides a solid entry point. When all these conditions are met on a specific candle, we will proceed to open a long order at the open of the next candle. For risk management, you can set a stop loss on either the 50-period moving average line or the recent swing low, depending on which is closest to the entry candle. This approach helps in minimizing potential losses and protecting our capital. As for taking profits, our first target will be the recent swing high. This is a logical level to aim for, as it represents a previous resistance point. Alternatively, you can apply your own risk management strategy to determine when to take profits, ensuring that you lock in gains while allowing the trade to run if the trend continues favorably. By following these rules and maintaining a disciplined approach, we increase our chances of making profitable trades while effectively managing risk. Remember, sticking to your plan and being consistent are crucial for long-term success in trading. Here's another example of a long trade. First, ensure the 50-period moving average is positioned above the 100-period MA, both indicating an upward trend. Next, observe the Stochastic RSI crossing above the 20 level, signaling a good moment to buy. Confirm the trend by ensuring the price closes above the 50-period MA. Once all conditions align, initiate a long trade at the open of the next candle. For risk management, set a stop loss at either the 50-period MA line or the recent swing low nearest to your entry point, safeguarding your capital. When it comes to taking profits, target the recent swing high, a logical resistance point, as your initial profit goal. These steps provide a clear framework for entering buy positions in trading. And these are examples of long positions. I've made many videos like this, and my previous video explains using Stochastic RSI with trend lines. I think this can be helpful, so make sure to check out the link in the description. Now let's understand the conditions for entering a short trade. Entering a short position is the exact opposite of entering a long position. Let's start with the rules for entering short positions. Here are the detailed conditions for entering a short trade. First, confirm that the 50-period moving average is positioned below the 100-period moving average. This configuration indicates a downtrend in the market. Additionally, both moving averages should be sloping downward, reinforcing the bearish momentum. Second, watch the Stochastic RSI closely. Look for the Stochastic RSI to cross below the 80 level. This crossing serves as a sell signal, suggesting that selling pressure is increasing and presenting an opportunity to enter a short position. Finally, analyze the price action. Ensure that the price closes below the 50-period moving average. This confirms the strength of the downtrend and provides a suitable entry point for a short trade. When all these conditions align on a specific candle, this is the candle where we will enter the trade by opening a short order at the open of the next candle. For managing risk, consider placing a stop loss either on the 50-period moving average line or above the most recent swing high, depending on which is closest to the entry candle. This approach helps in limiting potential losses and safeguarding capital. As for setting targets, our initial target will be set at the recent swing low. This level often acts as a support point and represents a logical area to take profits. Alternatively, use your own risk management strategy to determine when to exit the trade, ensuring that you lock in gains while allowing for potential further downside if the trend continues favorably. This is the next example for entering a short trade using the mechanical strategy. First, the 50-period moving average must be below the 100-period moving average. Moreover, both moving averages should be sloping downward. Second, the Stochastic RSI should cross below the 80 level, indicating a sell signal. Finally, the price action must close below the 50-period moving average. All the rules are met on this candle, so this is the candle where we will enter the trade. We will open a short order at the open of the next candle. You can set a stop loss on either the 50-period moving average line or the most recent swing high, depending on which is closest to the entry candle. Our first target will be at the recent swing low. Implement risk management strategies to secure profits effectively. Now let's look at another example. First, ensure that the 50-period moving average is positioned below the 100-period moving average, indicating a downtrend. It's crucial that both moving averages are also sloping downward, signaling continued bearish momentum. Second, monitor the Stochastic RSI. Look for the Stochastic RSI to cross below the 80 level, which serves as a sell signal. This crossover indicates increasing selling pressure and presents an opportunity to enter a short position. Finally, confirm the price action. The price must close below the 50-period moving average, validating the strength of the downtrend. When all these conditions align on a specific candle, this is the candle where we will enter the trade by opening a short order at the open of the next candle. Remember to use your risk management strategies to take profits effectively and minimize losses. I personally use this strategy in my trading plan, and my testing has shown positive results. That's why I'm sharing it with you. But remember, don't follow this blindly. Test it thoroughly to understand its limitations and behavior. Only use this if your own testing confirms it works for you. And lastly, if you found this helpful, so please subscribe to our channel, like this video, and click the bell icon for more trading tips and strategies. Thanks for watching, and happy trading.